Good evening, ladies and gentlemen. I do like a challenge, and so trying to mount an argument for investment into this share market at the midst of a global financial crisis is certainly going to be a difficult task, but I'll see how I go. I thought we might just set the scene with a bit of history. Shares were first issued back in the late 1500s by companies looking to finance the transportation of goods around Europe. The Amsterdam Exchange was the first stock exchange that came into being in Holland in 1611, and the first company to trade on the exchange was the Dutch East India Company, a merchant trading company within the Asian region. Looking back closer to home, the Australian Securities Exchange was created by the merger of the Australian Stock Exchange and the Sydney Futures Exchange in July 2006, and it's the primary stock exchange group in Australia. It's also the trading place within Australia to buy and sell shares and other various financial instruments. And the ASX functions as a market operator, a clearing house and a payment systems facilitator. And as most of you will know, the ASX is also listed on the Australian Stock Exchange. So what exactly is a share? Well, in fact, it's a company, or when a company divides its capital into units of equal denomination, each of these units is called a share. These units are offered for sale to raise capital. Now, by acquiring a share or shares in a company, the shareholder in fact becomes an owner of that company. And obviously, it's Glenn's brought up the discussion about the difference between paper money and bricks and mortar, and obviously it's a key distinction between property and shares. And just because you can see and touch and you can walk into a property, it makes it no less valuable than ownership in a share. And in fact, if I hadn't left my left hand here tonight a share certificate for, say, a $500,000 investment in BHP, and in my right hand I was holding a set of keys to a South Yarra apartment, which was also potentially valued at $500,000, which are you going to think is more valuable? I would suggest you're going to think it's property because you can see it, but in fact there's no difference between the two. So a share is not a share, much in the same way as Glenn has talked about the different types of property. Shares can be divided into different industries and sectors. So just a bit of information here. As at March 2010, the three largest sectors by market capitalisation were financials, 36%, so obviously we've got the major banks and QBE, AMP, resources, 22%, BHP, Rio Tinto, and consumer, 13%, so companies like Woolworths. Telecommunications and infotech also make up, and healthcare also make up other major sectors, Telstra and Ramsay Healthcare being two major companies. So how is the market measured? Obviously, we've talked about the fact that the Australian share market tends to be a much more volatile asset class than property, purely because we can basically value it every second of every day. And we do that by looking at the ASX 200 index, which is obviously the major market index, measuring the top 200 Australian companies by size. The All Ordinaries index, which was formerly the major market index, it measures the top 500 Australian companies by size. And another index which doesn't receive as much attention but potentially should is the Accumulation Index, which measures not only the growth of the share market but also the income that shares provide, and it assumes that the income is reinvested to purchase more shares, that is. So in terms of the features of the Australian share market, well, obviously it's a growth asset class. We wouldn't invest in it if we didn't want to see the value of our investment grow. It's very easily valued, unlike property. As I've just talked about, there's various markets, indexes that are available to measure the value of the share market. And look, potentially the only way to really see what's happening in the property market is to open up the paper on a Sunday and have a look at what properties have sold for, or looking at auction clearance rates. It's a liquid asset class. If I could use the example again of these two investments of about $500,000, let's say that $500,000 asset in Australian shares was invested in amongst a portfolio of different companies, not just BHP, as opposed to that $500,000 investment into a property. The $500,000 share portfolio was able to be broken up into pieces. So you have the ability to liquidate a smaller portion of that total portfolio to fund any kind of expense. Unlike property, you can't go and sell off the third bedroom to fund a new vehicle purchase or a holiday. There's next to no outgoings when you purchase Australian shares. Aside from the brokerage that you pay for the initial investment, the only other expense you're going to incur is when you go to sell the investment, you pay some brokerage again, and hopefully you have to pay some capital gains tax, because although we all hate tax, it does mean you've made some money. Again, unlike property, where we have a significant stamp duty and legal cost to purchase the property, we then have significant outgoings along the way, such as council rates and maintaining the property. The share market provides you the ability to diversify. We've talked about the different types of sectors within the Australian share market. So, you know, let's again say we had, for example, a $500,000 investment in a portfolio. You can diversify your assets across a number of different sectors, as opposed to that one particular real estate asset. You can't split that up across different areas. Australian shares pay reliable and predictable dividends. I've said here, unlike property, potentially a bit of a stretch, but property obviously pays a rental return. But if you're going to own an asset over a longer period of time, you have to appreciate the risk of not having tenants in that property for a period of time, so therefore you won't be receiving any income. And a very powerful benefit of Australian company shares is the provision of imputation credits. I think it's important just to touch on exactly what imputation credits are. Effectively, a company pays 30% tax on its earnings. Once the tax is paid, these profits are then distributed to shareholders in the form of dividends. And to ensure that the shareholder doesn't have to pay a second round of tax on the same profit, that tax that the company has paid is refunded back to the individual in the form of what we call an imputation credit or a tax credit. Just some examples up on the screen here. We've got National Australia Bank, pays a dividend yield of 6.3%. It's 100% fully franked, which means 100% of that company tax is refunded to the individual. And when you add that tax back into the income, you get a grossed up dividend of 9% per annum. Now, as we all know, that's about 3% higher than the current term deposit rate. BHP is another example, slightly different beast in that it's more of a growth type company, so it does reinvest more of its earnings and pays a lower dividend as a result. But again, it's still 100% fully franked, and therefore we see a grossed up dividend yield of 3.28%. Imputation credits are particularly valuable to individuals on lower tax rates and also superannuation funds. Super funds obviously pay a maximum rate of tax at 15%, or in fact pays no tax at all when it's paying out a pension. So what happens is you're seeing a 30% refund going back into an entity that only pays 15% tax. So it's getting a 15% tax benefit, and if it's not paying any tax, then that tax credit is paid back to the fund as cash. So now let's have a look at the returns of the Australian share market. Before I get into this, I'd just like to have a look at three factors, three variables that affect the end return to the shareholder. Those being the ownership structure and tax rates, the time frames for investment, and isolation of time. So in terms of ownership structure and tax rates, well, I've really just touched on that, and that is that from an income perspective, your overall return is going to be affected by the amount of tax you're paying, which is obviously dictated by your marginal tax rate. If you're a superannuation fund, obviously the tax rate is going to be lower, as is if you're a lower income earner. Very important fact, a very important point that we need to remember that we're looking at the overall returns and we're comparing, I guess, apples with apples, is that we do look at that after-tax return, because it's the benefit of that imputation credit to individuals and to super funds that is going to provide a greater benefit from an income perspective than property. Now, in terms of timeframes, you know, if you invest, if you have a share portfolio with Hewison Private Wealth, it's highly likely that you've had a discussion with your advisor about timeframes for investment, and the fact that we really we really recommend that you have a time frame in excess of 5 years and ideally 10 years plus. Now, the reason being is, if we take the last 3 years as an example, if an individual wanted to invest for the last 3 years, obviously they're going to be pretty unhappy if they looking at that isolated time frame. The reason we recommend a longer time frame is purely a protection mechanism, so that if there are any short-term falls or short-term declines in the market like we've just seen, there's an appropriate amount of time for the investor to experience the recovery in the market. And I would suggest that over a 10-year period, or we're going to show in a minute, that over a 10-year period, regardless of short-term fluctuations, you're going to be ahead. Isolation of time is a very interesting one, just in the sense that returns can be manipulated if you try to hand-pick or take a snapshot of the market in time. So, for example, if you wanted to, if someone wanted to paint an overly negative picture of the market, they could take the isolation of time around 1987. Obviously, the market had a steep decline over that period. Conversely, if you wanted to paint an overly rosy picture of the market, 2003 to 2007 would have been a fantastic time to value the market. So purely, I guess, for my own interest and hopefully yours, what I'm aiming to show here is, if you go right back in time, back to 1919 through to the year 2000, and you take 10-year periods and then 20-year periods, which would include a market probably going to include a pretty significant market downturn and a market upswing. What you actually see is that the average return is sitting around that mid-teens percentage, which is pretty much what we'd expect. So if we do actually have a look at the All Ordinaries Index, effectively over a 110-year period of time, this graph shows a couple of things. It does show volatility, which we can't deny, and again, that's purely because of the fact that you can value a share every second of every day. But what it also shows is that in excess of 80% of the time, the Australian share market is increasing in value. And down the bottom of the screen, you can see here that the All Ordinaries Index has actually returned, on average, growth of 13.5% per annum. And that doesn't include company dividends and imputation credits. So when you add them back in, the average return over the last 110 years is 16.5%. And these, as much as some people struggled with that concept and struggled to believe that, the figures don't lie. Now, my colleague was very crafty in showing you the 10 and 15-year returns of property versus other asset classes, but he must have left out this little doozy. This is the return of all asset classes over a 20-year period. And what you can see here is, in fact, over a 20-year period, Australian shares has actually outperformed all other asset classes. Now, for those of you at the back here, the different bars on this graph here show in grey the gross return. In the mustard colour, it's an after-tax return for the lowest marginal tax rate. The yellow is an after-tax return for the top marginal tax rate. And then the blue is the return for superannuation. So what you can see is the returns are going to be affected by the tax rate of whatever ownership the fund falls into. So obviously, superannuation has provided the superior return there because it pays the lowest amount of tax.